Good afternoon. Thank you for taking the time to listen to me and for hosting me here today. I am going to spend the next 30 minutes sharing with you my views on the global equity outlook. There's a lot to talk about. Some of the topics were just covered in the poll, and we'll touch on each of those during this discussion. But in order to give you a flavor for the way we think about investing, which is very much a bottom-up approach to investing, I'll take you through some of the investment process that we employ that helps to shape our outlook of the global equity market. And so I will start with a quotation from Benjamin Graham. Now, Benjamin Graham is known as the godfather of value investing, but he was also an early proponent of looking at behavioral bias and how that impacts people's investment decisions. And so the quote, which you can read here, "To invest successfully over a lifetime does not require a stratospheric IQ, unusual business insights, or inside information. What is required is a sound intellectual framework for making decisions and the ability to keep emotions from corroding that framework." And it's really that second part, the emotions, keeping those from impacting our decision-making, that shapes our discussion today and the exercise that I will take you through. And so as part of our investment process, we employ exercises throughout the course of the year in order to make sure that we're aware of some of the common behavioral biases that impact negatively every investor's decisions. And so many investors are impacted by overconfidence. They don't want to admit that they're wrong. Many of them are focused on the short term rather than thinking of some of the long-term trends that are likely to impact the ability of companies to compound value over the long term. Herd mentality is also very common with investors. I think we saw possibly some signs of it in the poll here this morning. Over 90% of individuals here favor the US equity market, so that's a herd chasing equity in one region. And so we want to be cognizant of that when we're making our investment decisions. And then finally, risk aversion is an important topic for us to be cognizant of as investors, because as active investors, we are paid by our clients to take risk. And we need to be comfortable with taking risk and applying that within our portfolio decisions. But what I'm going to focus on today in this discussion of the market outlook is recency bias. Many investors make their decisions based on things that they've heard most recently. Perhaps it's a meeting that they've just had with the company management team. Maybe it's a consumer price index quote that came out yesterday, and they use that to shape their investment decisions. And so we do an exercise with our team that helps shape this market outlook that forces us to look far ahead into the future in order to help guide the way that we're managing our portfolios. So an exercise that we did with our investment team 2 months ago at the end of April is called the Time Traveling Reporter. And in this exercise, we imagine that we can go into the future and look at what the world looks like 1 year ahead. And so in this particular exercise, the Time Traveling Reporter goes into the future and needs to write 3 headlines for the Wall Street Journal for the date April 30th, 2025. And then we ask each member of the team to do this in order to determine what's on their mind, what's the world likely to look like in 1 year ahead. And it can touch on economic issues, financial issues, geopolitical issues, elections, technology. And we collect these insights and we put these all together and try to determine how should we position our portfolios today in order to prepare for the future. So we all look into our crystal balls and we come up with our headlines that we're going to see 1 year from now. And so I'll go through some of the headlines and they'll help to form some of the themes that we think we'll be facing over the next year and beyond. NVIDIA dethrones Microsoft as the world's most valuable company. Whatever happened to the AI boom? FOMO or the future, fear of missing out or the future, the AI spending spree continues. So the first set of these quotes all relates to artificial intelligence. So that's a very important technological theme that we're going to be focused on. The next set takes us into US politics and the impact that they have on geopolitics. President Trump claims ceasefire in Ukraine is my gift to Europe. So in this case, one of the team members expects Donald Trump to be the next president. Biden-Xi summit focuses on areas of mutual economic benefit. So this brings up the possibility that, President Biden is still the president 1 year from now. The next topic, Trump passes 10% tariff on all imported goods, brings in the idea of global trade and tariffs and the way that they might impact the equity market. And then we have a headline here which suggests that, again, Biden will be president rather than Trump. Now we move on from that to touch on elections. In the world this year, in 2024, there have been more than 70 elections across the globe. You've had an election here in Taiwan earlier in the year. Last week in the UK, where I live, we had a very consequential election. France had a very important election, and we all, of course, have the US election in November. And that can have implications on geopolitics, so that's something that's been suggested here. The tension in the Middle East, there's some concern on the team that that could lead to instability and an impact on the oil price, which would certainly have an impact on the global economy. And then finally, the last two deal with some typical macroeconomic factors, inflation and interest rates. So the expectations of what we might see there, as well as the global economic growth and growth in China in particular. And so as a team, we come together and we discuss these, and we incorporate our views on this into the decision-making that we make. Now, when we discussed this at the end of April, I asked members of the team a few basic questions about the year ahead. I'll ask you the same questions. So let me just have everyone give a show of hands in response to these two questions. Who will win the US presidential election in 2024? I'll give you two choices, Donald Trump or Biden or someone else from the Democratic Party. And we'll talk a little bit more about that. So please, quick show of hands, who thinks Donald Trump will be the next president? Okay. Who thinks that either President Biden or another Democrat will be the next president? Excellent. Okay, good. You are the first individuals in my week in Asia that I've found that have suggested that maybe a Democrat will be the next president. So I think there's a stronger possibility than this vote would suggest about that being the outcome. Now, another fundamental question that will impact our portfolio and how we manage it, is the market going to go up or is it going to go down? Okay, again, quick show of hands. Raise your hand if you think the market is going to go up. Okay, a little bit more balanced. Who thinks the market is going to go down? Okay, interesting. Now, when we did this with the investment team, what's interesting is each member of the team has more than 20 years of experience. They're very experienced investors with a lot of expert insights, yet we don't know whether the market's going to go up or down. Half the team thinks it's up, half the team thinks it's down. So how do we position the portfolios as a result of that? That's something that we'll talk about. And then there was another interesting outcome that I think points to behavioral bias in this poll that we did with the investment team. Each member of the team that said that President Biden would be reelected also said the market was going to go up. Each member of the team that said that President Trump would become the next president said the market was going to go down. And I think there's bias in those outcomes. I think there's a little bit of optimists in the room and pessimists in the room. And we need to keep in contact with our views on whether that's likely or not. Now, I'll just run through some of those topics that you saw in the headlines briefly, and some of these will be quite obvious to you. Artificial intelligence is nothing new. We've been talking about artificial intelligence the last several decades. But what is interesting here, this is a analysis of the number of quotations in company results in which artificial intelligence is mentioned. And so what we see is every company across every sector across the globe is talking about artificial intelligence and how they're harnessing it. That's obviously showing through in the results of TSMC and NVIDIA. That's something that we expect to continue in the years to come. We spoke about the election as being consequential for our global equity market outlook. And I think this is an interesting analysis of previous periods when the US president was up for re-election. And what you see here is that in each of the last 13 instances when the US president was up for re-election, The US stock market did very well. On average, it was up about 16%. Year to date, the US S&P 500 is up 17%. So this year is nothing unusual. This is very consistent with history. Why is that? Well, the US president has a lot of ability to spend and to incentivize positive sentiment amongst consumers in the country, and that is playing out during the course of this year. Now, another interesting measure that is very useful in predicting the outcome of presidential elections is something that's simply called the misery index. So how much pain is the US consumer experiencing can often predict who will win, the incumbent party or the challenging party. And so the misery index is simply the last 3 average months of unemployment rate plus the last 3 months of inflation rate. You come to a number. Historically, and in I think 13 of the last 15 presidential elections, if that number was at 7.3 or below, the incumbent party was reelected. If that number is above 7.3, the opposition party becomes elected. What's interesting now, that number was at 7.2 at the end of April. At the end of May, it was at 7.267. So it's creeping up to that very fine line of 7.3. So again, if you're a global equity investor, it could go either way. The election is difficult to predict, and we don't want to make a bet one way or the other as a result. Now, we've spoken about some of these geopolitical topics already. A multipolar world has evolved over the last 15 or so years. The US and China are in a competition, and that is essentially resulting in them trying to disengage their economies from the interdependence that prevailed previously. That's having an impact on trade. We're seeing a lot of restrictions on technology, for instance, being sold into China. Tariffs are being imposed not just by the US, but also on European companies, or sorry, the European governments are putting tariffs on electric vehicles coming out of China. And Donald Trump has said that if he's going to be president, he would like to impose 60% tariffs on Chinese goods. So that is going to be consequential, particularly depending on the outcome of the election. There's a significant impact, therefore, on the supply chains, which are being reshored to Western countries. A lot of semiconductor manufacturing is being incentivized to come to the US. We're seeing that also in Europe, as well as just manufacturing facilities being moved to Southeast Asia and also to India. The consumer has been a very interesting topic in the US equity market, and what I think is really surprised investors over the last couple of years is that the US economy did not go into a recession despite the very high levels of inflation. Most analysts expected a recession. It did not occur. And why was that? Well, between the end of 2019 and the present day, more than $30 trillion of wealth was created for US consumers, primarily through the appreciation of the stock market and also through the appreciation of their houses. And that appreciation in their asset values offset the inflation pressures that they were experiencing. We think that this is going to continue to be a focus, particularly for low-end consumers, where the inflation impact is greatest and they have not experienced the benefit of the asset appreciation. Now, it's important when looking at the path of the stock market to look at where are earnings trending. And what is interesting with this looks at simply earnings revisions breadth, so the percentage of companies that are increasing their earnings versus the percentage of companies that are decreasing their earnings outlooks. And what you see here is the blue line looks at the earnings revisions. And over the last couple of quarters, so in the recent periods, you're starting to see a recovery in that, which is certainly good. Why is that? Inflation's come down, so the pressures on companies' margins have abated. You're starting to see an improvement in the European economy. And so in aggregate, the world is getting a little bit better for corporates. However, the yellow line shows that over the last couple of quarters, the end of 2023 and early 2024, the equity market moved up before the earnings revisions. I think that the reason for that is that the equity investment community has looked through the fact that the interest rates were not coming down. There was the expectation, but they said, okay, we're going to eventually see the interest rates fall. and we're going to let the equity valuations appreciate in advance of that. I think that's important because with the expectation that interest rates in the US will start to come down, they've started to come down once in Europe, further to go, I don't see that as a catalyst for the equity market. I think a lot of that is already priced in. This looks at the similar earnings revision metrics, but breaks it down by geography. The top line, I think, is interesting. The TOPIX, which is the Japanese stock market index, has been the best in terms of earnings revisions over the past year. I think that that is the outcome of a lot of the efforts that have taken place in Japan to improve corporate governance, to improve the returns on invested capital, and now you're starting to see that come through in terms of better earnings. I think that is something that gives us a positive view on the Japanese equity outlook, not just for the next 12 months, but for the long term, because there's further improvement to come. What other thing I would point out to you is the yellow line, which you see the dramatic improvement over the last year of European companies. And that's important to focus on. I think that the outlook is very positive for European equity, unlike virtually everybody else who voted in the poll earlier today. And why is that improving? Again, a little bit of a better economy in Europe, as well as the inflation rates coming down. Magnificent Seven, I think the story is well known. It's not just over the last year or two, but the 7 largest companies in the market have really driven returns of the US market in aggregate. And so you see the performance of the Magnificent Seven at the top of the chart here in dark blue. What's interesting is over the last 2.5 years, you look at the S&P 500 on an equal weight basis, so not giving the credit to the size of those 7 companies. The market is basically flat over the last 2.5 years. And so you have a very dispersed market within the US of a few companies doing very, very well, so crowding in terms of the concentration of returns, but the long tail not doing so well. I think that illustrates some of the momentum that we see in the market, as well as some of the opportunities for stock pickers going forward, bottom-up investors, when the market starts to widen. The output of that outperformance of the US equity market over the last 16 years has been dramatic and has reshaped the weighting index of the US in the global indexes. And so around the financial crisis in 2008, the US market was around 40% of the global market. Now it's nearly 70%. To me, that looks like an imbalance relative to the global economy that on average I would expect to correct to some degree in the coming years. A few words now on valuation. Valuations are very stretched in the US market. This slide looks at the cyclically adjusted price to earnings ratio. That's a measure that looks at historical 10-year earnings in order to smooth out the cyclicality that takes place in the market. And what you see here is the US does look a little bit expensive based on its history. Part of that can be explained by some of the big companies that have attracted high valuations that now comprise the Magnificent Seven, are now 1/3 of the S&P 500. And so that has lifted the average. But you can look at this and think the US market looks expensive relative to its history and relative to other markets. What gives me comfort is that the other regions look either inexpensive or in line with their historical averages. And so Japan actually looks less expensive. Europe and emerging markets look basically in line with their historical averages. Now, I'll look next at the nearer term earnings outlook from a price to earnings valuation over the next year. And what stands out here is, again, the MSCI USA illustrating the US market is well above the others. The bars, the gray bars, they illustrate the range of the PEs in those markets over the last 10 years. And the blue diamonds, which there are no blue diamonds, so 21 is the current value of the US market. Its 10-year average is 18.4. And so what that means is that the US market is trading at a 15% premium to its 10-year average. So more expensive. There's a lot more expectation for the US market. However, if you look at Europe, on the other hand, it's trading at the bottom end of its historical range at 13.3%, which is a discount to the 14.2 average over the last 10 years. Japan is trading at a little bit of a premium, but sort of in the middle of the range, and emerging markets is basically in line. And so what that indicates to me is that there are some opportunities for investors outside of the US going forward. I'll say a quick thing about momentum. Momentum has really been at an elevated level. It's the best performing factor over the last couple of years. And you see it's at a very stretched level right now. So only 3% of the time in the last 25 years has momentum been at such an extreme. Now, if you think about some of the companies that illustrate that momentum, there are some of these big technology companies that are tied in with AI, the Magnificent Seven. And so the momentum that we've seen illustrated to them has taken the factor momentum to this level. And it's natural to expect that that's going to come back a little bit. We saw a little bit of that yesterday in the market, and that's not to be unexpected. That doesn't mean that those companies can't perform longer term, but it does set the scene for a potential pullback. Okay, now I'll just include a slide here on Japan. I've mentioned that there are some exciting improvements taking place in Japan that are very interesting. The two charts here look at the MSCI IFA index, so the non-US index. The top chart looks at it excluding Japan, and the bottom chart is the Japan. And this looks at returns on invested capital. And so I would just encourage you to look at the last 35 years of data here, and the bottom chart. Japan has structurally improved its returns on invested capital. Returns on invested capital are a primary driver of shareholder returns and compounding value for companies. And so we've seen improvement. There's more to come, I think, in Japan, and that sets a positive outlook for Japanese equities. So I'll run through my conclusions pretty quickly and then give you a few words on how we incorporate that into our current positioning in our portfolios. Uncertainty endures. We think that the market uncertainty that we have illustrated today, that our team has different views of what's going to emerge, that's going to continue. That's why it's important to look at different scenarios when you're doing your asset allocation or your stock selection. Artificial intelligence is here to stay. We still think we're at the early stages of this development. We're overweight companies in our portfolio. We have owned TSMC for a long time. We own Microsoft, NVIDIA, et cetera. So a lot of the companies that tie into that theme are represented. US election, too difficult to predict. I think, if you ask me today, I think that there will be another Democratic candidate, not Joe Biden. And I think that Democratic candidate will have a very good possibility of winning. Probably too long to get into that, but I do think that it's too early to anoint President Trump as president. Elevated geopolitical risk will persist. That's going to be here for decades. But you know what? There's always been geopolitical risks, and the equity market has done well for the last many years, despite those risks. And so I think that that shouldn't scare off equity investors. Interest rate declines, as I mentioned, I think are already priced in, so we shouldn't expect that in and of itself to be a catalyst for the market. Valuation matters. We saw this in 2022 when the market fell significantly. As interest rates started to rise, a lot of those companies did not recover from those falls, and so I think it's important to be very disciplined. Beware of momentum. I mentioned that earlier, and it's at an extreme. We should expect some pullback. We favor Europe and Japan in our portfolios over the US and emerging markets. Europe has attractive valuations. Japan has a structurally improving market. And then the other thing with Europe, a lot of people are negative on Europe because of the European economies, but more than 60% of revenues of European companies come from outside of Europe. And so there are many drivers to these companies beyond their borders. We should expect some more moderate equity returns. We've had very good returns this year. We had good returns in 2022. I don't think we're going to get a re-rating, possibly even a de-rating in the US. And so I think that the market going forward is likely to be driven by earnings growth and more fundamental returns in line with that. And then finally, Robinson Crusoe for an attractive return journey. This is the way that we think about investing. This is our investment philosophy. So Robinson Crusoe, you may be more familiar with this by the Chinese name, which is Liu Binshen. Okay, I practiced this all night, and I've now forgotten. Piao Liu Zi. Piao Liu Zi. So Robinson Crusoe tells the story of a man who gets stranded on a desert island for more than 30 years. And we take that narrative and we try to translate that into our investment philosophy. And so we asked members of our team, if you were stranded on a desert island for the next 10 years and all your personal wealth was concentrated in one stock that you could not sell or trade for the 10 years, which stock would you want to own? Now, if you were stranded on a desert island with all your wealth, you'd want a company that you had very strong conviction was going to be worth more in 10 years than it is now, despite whatever may occur. So there might be a war, there might be high inflation, low inflation, a pandemic, Donald Trump, a lot of uncertainty. And so you need to focus on the quality of the business model. And that's why we favor sustainable business models and try to make our compounding returns from the strength of the business model rather than predicting the outcomes. So we look for companies with tailwinds of secular growth, high gross margins, high returns on invested capital, high barriers to entry that enable investors to preserve those levels of returns. These companies will have strong pricing power that enables them to pass on inflation, which has been critically important over the last couple of years. Strong balance sheets so that the company doesn't go bankrupt over that time horizon. An excellent management team that you can trust as stewards of capital. And finally, strong ESG credentials that can help to keep the company from derailing its sustainable business model over the long term. If you have companies in your portfolio that have those characteristics, ultimately what you get is a Robinson Crusoe-like portfolio that you can trust. If an allocation to that portfolio on a 10-year horizon, regardless of what happens, you should be able to see a good compounding appreciation in the value of your investment. There's some quantitative elements that support this. This is a simple analysis that shows 3 key metrics in what we think are sustainable business models: sales growth, returns on invested capital, and gross margins. If you invest in companies as represented in the first or second quintile that have the highest characteristics of those, and you hold those companies for 5 years or longer, they consistently outperform. And this is held for several decades. And so there's a really strong academic and quantitative backing for this approach to invest in sustainable companies. And so just sort of in summary, what I would just say is for an attractive return journey, which is ultimately what we as investors are trying to deliver to our clients, we want to, whatever happens, despite all the uncertainty of the market outlook, we want to deliver an attractive return journey, whether the market's up or down, that can be, enable investors to sleep well at night, knowing that they have the opportunity to compound over the long term. That requires 2 things: a sound intellectual framework. So from our perspective, that's our Robinson Crusoe philosophy that forms the backbone of our portfolios. And then you need to be able to compete, you need to be able to keep emotions from corroding that framework. And so we do that through regular use of portfolio exercises that require the team to challenge their existing thinking, think into the future, extend their investment horizon, but also to represent all the risks and uncertainty, but feel comfortable taking risks, because ultimately that's what we're being asked to do by our clients. So I hope you appreciate that outlook, and I'll be on the panel later today and happy to address any further questions. Thank you.
Thank you so much, Chris, for your insightful presentation. Thank you.